So welcome again. So we learned that there are three kinds of trades, and there is four-step kind of strategy that is being used by me for coming to a point where I can take profits and go away for a short-term duration of portfolios, or I exit much beforehand, taking certain losses, and I'm calling it the 10-4 rule, right? So in this one, we will go through the strategy being used as a step or a methodical way of coming to the point of entering and exiting a trade. Okay. Now, if you remember the higher highs and the lower highs, right? On my screen, if you see, right, if you see this example of some particular movement of a stock that is here, right? So if you see the red ones or the orange ones, if you, depending on the screen that you have, right? You see this is the lower of that particular kind of motion that is happening. Now this is going here. Now this is a lower high. Okay, it has gone here, lower high. Similarly, it was here for high, it was higher high here, it is higher high here. Okay, now this is a typical motion, if you remember I was talking about, as a higher high and a lower high, right? These are basic price action rules. So once that is on, that means the stock is going up. Now look at the other side, right? This side on the which is diminishing. After this point, you see this guy's come down. The next one has come even down. So lower lows are getting created. Lower low, lower low. Now what you saw is a high here, right? On its way down. It's saying higher high. There's a higher high from this guy, right? But there's a lower low. But when you see the next candle, it is a lower low plus a lower high. Then the subsequent one, lower high, lower low, right? But then it went again higher high, lower high. So this causes confusion, right? But if you look at the larger picture, this guy has come down to the last one, what you see as a big one. The higher high has come to the higher low. The lower has become lower low. That means it's on the way down, right? But then you see again reversing. Now this is where the confusion starts for everybody. But the price action done in a systematic fashion will let you know this much beforehand by by actually seeing different time related or other time frames related activities with the same stock motion in the graph, and that will teach you technique, and that is how you use technical analysis to your advantage to take a decision on this. And we'll see that a practical one, which as a subsequent one, so that you know how this is seen and how you can take trade. And it might be sounding very difficult now, but once you see it, your criteria might change. Okay, so here's what it is. Short-term strategy for portfolio, as I told you, is the 4-point SAPR strategy, which is described in the box here, and I'll come to it in a minute. I told you about the 10-4 rule, right? Either you exit using 10% as your exit in terms of profit and out, and if you think the stock is still going strong, then you pyramid it, or by 4% loss you come out, or a 4% down you exit, or you exit at 10% itself, so that you're doubtful of what's going to happen next. Clear? Pyramiding with momentum is an important strategy even to build a long-term kind of portfolio. Okay. Why? Because you don't see now these are short-term trades you see in short time frames. For a long-term strategy you see on a long time frames, right? And what that means is, for short time frames, depending if you're doing scalping, then you're going to minutes, 15 minutes, half an hour, 30 minutes, and so on and so forth. If you're swing trading, then you see over a time of days. You see each candle is a representation of a day, or maybe sometimes week, just to be sure that what you found out is right in the higher time frame also. And you'll understand time frame, etc. guys. Just listen me out right now, in case you're getting a little confused what time frame and what candles, etc. Once I take you through a practical scenario, you'll typically get it there. Then there is just acclimatize yourself with the what I'm throwing at you as names and some technical terms. Okay, just assimilate, and then we'll jump into it. And once you see it in your screen, you'll be just very clear. So with that said, momentum is something where the stock is in motion, either upwards or downwards, right? Based on that, you pyramid it out. Okay, so typically pyramiding happens when you buy stock and create portfolios towards up. So when the momentum is showing that it's going up, higher highs and lower highs and so on and so forth, then you as a 10-4 rule, you start my 10-4 rule, but something is such a good stock with the same good fundamental, etc., then you take into a large time frame and you start putting it in your larger portfolio. Clear? Okay. With that, for all this, you typically use price action. So 4 key steps. Number 1 is use 4-point for the SAPR strategy, which you're going to cover in a minute, right? This will talk about how you take a trade and you exit from a trade. Number 2, use the 10-4 rule. 10% profit, pyramid, if it's a good stock, 4% loss and out is an exit route. 4th, if you're pyramiding, go with the momentum. That means if the stock is going up and showing you right signs of that going up through indicators in your price action activities, then it goes up. Then you take your pyramiding through. And then from a larger perspective, you take your decision based on price action, which you talk about higher highs, lower highs, higher lows or lower lows and so on and so forth. Clear? Right. So always remember, when we're talking short-term trade, it's all about price action. That means what is happening with the price of that particular stock and the indicators. So I'll talk about several indicators there, which can show you what is going to happen with that stock. Okay. Some of these indicators are called, they give you preemptively what's going to happen, and some of them follow the price action to give you an outcome. Clear? So with that said, let's jump into and understand what is those 4-point steps for SAPR. SAPR stands for screening, analysis, position sizing, and then risk management. Right? These are 4 specific criteria for taking an entry and an exit for a specific stock trade. So what is screening? Screening is finding the stock based on your criteria, right? For example, you might want to only work with blue chip companies, right? And see which of them have a bullish pattern right now. That means are running up based on certain news that you heard, right? Or you might get into a mid cap because you might either see, hear, or even observe that mid cap companies, that is, the mid cap typically are companies which are falling in the bracket of below about $5 billion. Okay, that's the company size, and they vary. Okay, so there's no definitive kind of clause to it. So 2 billion to 5 billion, or rather 1 billion to 5 billion is a mid cap, right? That is middle level of capital, if you will, right? So those are those mid cap companies, and you think those are the ones that are going to spruce up and jump to the next level to become a large cap later on. But so large capital or middle capital, or mid capital or a small capital, you define yourself accordingly. Or you might look at a sector, that is oil and gas is doing very well, or energy is doing very well, or automobile is doing well because there are new cars coming out, and various criteria. So we'll see those criteria also for long term as well as short term. But typically for short term, they see which is in the momentum. That's a simple criteria to see. That is, any of these stocks, large, mid, or small, are going in a fashion which is in a growth mode and are growing with time almost every day. So then you put the screening. That means out of those 5,000 whatever stocks out there, which are the ones which are on the top knot, and you pick up the one that you want to run with based on the analysis you do. Okay. So first is screening. Second is analyzing. So once you shortlist a stock that you want, a shortlist number of stocks that you see as happening, you pick and start analyzing it. How do you analyze? You use price action, and I show you how that works in a very simplistic fashion. The detail and the advanced methodologies will be taught in the practical sessions. Okay, because this doesn't come unless you do it. Okay, so price action, and then you use something. You use technical indicators called MARBS, right? And I'll talk about them once I show you the screen. And for people who are a little inquisitive right now, it stands for MACD, it stands for ADX, R stands for RSI, B stands for Bollinger Band, and S stands for parabolic SAR, or the SAR. Okay, so, and there's TRB, which again we'll cover there. So you would have heard these names if you are already trading in the marketplace. If not, then if they are new, then you'll understand how to simply see it. I will not go into details of what that indicator is formed from and why it does do, because there is a whole detailed description If required during a rise circles, I will complete it there. But currently it's from an understanding. So and the larger purpose being to grow your income. Okay, so that's that. After you analyze, you know the stock is right for you. After those 5 stocks, you may pick up one. Then you do a position size, and I'll give you a calculator for doing that. Based on your risk criteria, you put certain inputs, and you'll know that this is my position, this is the amount I want to kind of put into the stock at this point of time. And once it reaches my criteria, I might go up to the next lot, that means upwards of the pyramid, or I exit. That's your position sizing. And fourth one is risk management. So once based on the above criteria of position sizing and whatever investments you want to do, you take an entry, right? And I mentioned the 10-4 rule, which is all about against 1% loss, you want a 2.5% kind of a reward. So the risk reward of 1:2.5 is what works best for me. Based on that, you do your 10-4 rule or your 1:2.5 or 1:2, or some people you use even less, right? Based on their respective requirements. So I use 1:2.5, which is 10-4 rule. And you can do the same for short-term trades. Okay, long-term is looked at very differently, so we'll come to that. Right, it's more pyramidal and so on and so forth. The risk management typically deals with entry, re-entry, or averaging it out. Okay, while you're on the way up. For a stop loss, SL stands for stop loss, right? So you stop them at a 4%. When I told you, right, from 100 when it comes to say maximum 96, you want to get out. So you put a stop loss there. Something called stop loss means that the system will automatically take you out of it. Okay, either you monitor it, or you typically, if stop loss reverses before your stop loss is hit, then you pyramid it. Simple, and then you average it up. So those are some criteria of doing that. And then after all this is met and you see it going down, then you exit. Or if it's gone up to a point where the pyramiding might not help, then you exit. This is the simple 4-point steps for meeting your short-term goals with your stocks. Okay. With that said, I think we'll jump on to the next one, and you have to download the position. This is the calculator, guys. Okay, and it has other ratios which will be used for long-term strategies. So my suggestion is, please click the link below and download your Excel sheet, go over it, and when I meet you next, we will discuss that in detail, and I'll take you through an exercise of showing how this works. Okay, I'll see you there in a minute.